Hey, it's Sasha Evdokov, and welcome to TRADERSFLY.com, where I share with you some interesting insight as well as some educational lessons about the stock market, investing, and in your money. Now, this week's lesson is all about some words of wisdom from some of the great investors and traders, and that is to scale in and buy stocks as they move up, not as they move down in price. So before we even get into evaluating and analyzing what some of the great traders and investors said about scaling, let's understand what is scaling and why it's somewhat important to understand. Basically, you can do scaling in two different ways. So as a stock is heading higher, you may not want to put your full position on right away because you don't know if it's going to continue moving higher. So what you could do is you could go ahead and purchase some shares, and as that stock continues to move higher, you can purchase a few more shares. Now again, as we continue to move higher in price, you can continue to scale in more and more shares. So for example, if you started with 10 shares initially, you can continue adding 10 and 10 and 10 more shares up until you reach your desired share quantity, which may be 100. Now this methodology, it works out pretty well because the stock is moving higher and you're continually staying in profit. Now on the flip side, some people like to scale in as the stock is heading lower. So for example, as the stock is moving lower, you may purchase, again, let's say 10 shares, then it continues to move lower, you continue to purchase 10 more shares, and so forth. So you continue purchasing 10 shares as that stock heads lower until you reach your desired quantity of, let's say, 100 shares. Now, the problem with this, or kind of the issue with this, is now you're purchasing stock and you're losing your position in terms of profitability. Now, on the flip side, the advantages to this and what people really hope to achieve and gain from scaling in on the downward trend is that they hope that that stock will continue to move higher and bounce at some point because they're trying to catch it at a lower price. So they're hoping to get it at a bargain in hopes of the future working out into their favor. That way they can get it at a nice average price. Now, if we look at what some of the great investors and traders have said about scaling over the years, here's what Jesse Livermore said in the book Reminiscence of a Stock Operator by Edwin Lefebvre. I must buy on a rising scale. I don't buy long stocks on a scale down. I buy on a scale up. Now, Arthur Huprich, sometimes known as Art Huprich of Raymond James, said, don't average trading losses, meaning don't put good money after bad. Adding to a losing position will lead to ruin. So in the end, what are these great traders and investors telling us? Well, they're telling us that you shouldn't continue to put bad money into a bad stock. That's like continuing to pour more and more money in a fixer-upper. The better approach is to actually continue to put money into a stock that continues to reward you or continues to appreciate in value over time. So let's take a look at some different stock charts and see how these concepts apply regarding scaling in the real world scenario or how they would have played out over time. So here's an example of AutoZone, ticker symbol AZO. Now you can see that this stock continues to appreciate, and now it's currently in the 700s. Now the stock price was just $20 and $30 per share in the 1990s. And if you would have purchased 1,000 shares during that time, it would have cost you around $30,000 to purchase that stock. Now currently the stock price is around $740. So let's just say $700 in order to reduce some of that investment capital of $30,000 to make numbers simple. So on your 1,000 shares that you invested, you would be up or profitable of over $700,000. Now if you only invested $15,000, let's just say you didn't have $30,000, you still would have been ahead by $350,000. Now on the flip side, if you would have doubled your investment and invested $60,000 or 2,000 shares of stock in the 1990s, right around that $25 mark, you would be up about $1.4 million today. Let's take a look at this example of Priceline. Priceline in 2009 was around $100 a share, and now it's $1,200 a share. This stock continues to move up higher and higher. Even if you didn't purchase 1,000 shares right away, you might have started out with 10 shares. Then you might have purchased another 20 shares as the stock continues moving higher. then again, you could have purchased another 20 or 30 shares. Over time, you could have got to 100 shares, 500 shares, or 1,000 shares and continued to stay in profitability. Now, this stock again would have continued to make you money time and time again as that stock continued to move up to higher prices. As you can see, scaling into Priceline over time, even if you didn't have a ton of money to invest, would have kept you in profitability. And the same thing with AutoZone, because you're scaling in on a step-by-step basis. If we take a look at MasterCard, the same concept applies. It was $20 in 2008. Now it's currently in the 90s, but it did have a 10-for-1 split in 2014, putting that stock price roughly at $900 if you got in it earlier. So if you're looking to scale into a position because maybe you don't have the financial means to get into a stock fully right away, scaling into stocks that continue to reward you over time is a much better play, rather than scaling into losing positions in hopes of sometime in the future those stocks catching a bounce or getting back up to those higher prices. And that's what most people think, is that if they purchase a stock that used to be high priced, that it potentially could reach those high prices again sometime in the future. And that's why they'll purchase it on the way down. Now, if we take a look and evaluate at First Solar, which you could have done on a scaling down position, you can see that this stock was in the 250s and in the 200s. Now, currently this stock is in the 40s and in the 50 region, but so far over multiple years, this stock still hasn't gotten back up to those 200s and that $250 region. Can you imagine those people that purchased that stock, First Solar, right at those highs, still waiting and hoping to get out? Now, for that stock to get to those 200s and $250 region, it nearly has to quadruple, go 4 times the value, just so those people can break even without a loss. Here's an interesting example of AIG, which was once at $2,000 a share. And then in 2009, as you probably remember, we had that collapse of the market, and now it's under $100. So think of it in this way. If you were scaling into this position as that stock is heading lower, can you imagine how high you have to now wait for that stock to go until you're just breaking even? Imagine all those losses that you would have incurred or would still be holding on to, hoping and praying for that stock to just get back to those higher prices. And that's what happens with a lot of these companies that sell off from higher prices, is that anytime they get a bounce, there's just so much overhead supply, so many people waiting, just waiting and hoping to get out at a higher price so their losses aren't as big. And here's another example that I love to use. So AMD sold off from the 40s in the year 2000. It had some potential in 2006, which allowed you to get out if you were scaling into that losing position. But again, we had a sell-off and have been under that $10 mark since 2009. So if you think about your investments or the time value of money, holding on to that position in the 30s, you nearly have to be waiting for that stock to triple, go 3 times as high just to be breaking even. And right now, since that stock is under $2 and $3, you pretty much have to have it explode to the upside for you to just break even. So looking at these charts and somewhat case studies, you can see that I gave you somewhat of a more favorable position or somewhat favorable view to looking at charts that are more beneficial to purchasing stocks to the upside or stocks that are moving higher. So that's usually where you want to scale in. Now, if you did do it on the flip side and did manage to successfully scale into a losing position and then eventually that stock popped, usually those times are rare and few. The primary problem with scaling in on a losing position or a stock that's moving lower is that you can really get stuck in that price region or price bracket where that stock never breaks out. And now for 10 or 20 years, you may be holding that stock and it never gets back to even and you're holding out for a loss. Imagine all the other trades that you could have done or all the other investments that you could have done with that revenue or that capital. Now, if you are scaling in and the stock is moving lower, you want to scale in as that stock is pulling back lightly rather than a stock having a major sell-off. And in which case I may say that, yes, go ahead and you can scale in because it's having a minor, slight little pullback. But if you're looking at the long-term picture and you see on the long-term picture that stock is pulling back heavily, that is not the time to start scaling in and averaging your position. Now, I have seen some financial advisors and some financial articles written saying that, yeah, do you think that, big companies are going to go out of business, or very stable companies, and they'll make a justification and pick a name regarding a certain company. But I can think of a few companies in a few different instances where even though they had a very stable company, very solid stock movement, eventually still did collapse, got delisted off the stock market, or still are hanging at those low prices. So the problem with scaling in on a major losing stock or a stock that's really heading lower is that you can get stuck into a position and then that stock never breaks out and you're holding on to those losses for many, many years. So remember what some of the greats, along with Jesse Livermore, said is that I must buy on a rising scale. I don't buy long stocks on a scale down. I buy on a scale up. Thanks for watching this video. I hope you found it helpful and insightful. And if you did and you want to see other great videos like this one and more in-depth training that are not always on YouTube, you can click this link, and when you get there, you can browse the rest of the website, or you can enter your name and email address where I send out free goodies about some of the stocks that I'm watching and lessons and materials about trading and investing. Now, if you want to continue to hang out on YouTube and see some of the other training I have available on my channel, then click one of the thumbnails below and we'll continue learning together. Thanks again, and remember to do what you love, contribute to others, but most importantly, live life abundantly.